first quarter 2020 financial results of listed companies have been coming in as submitted to the Nigerian Stock Exchange. Some of the unaudited numbers across sectors are showing double-digit appreciation in their income lines, while quite a lot of the companies have been declaring unimpressive performances. Of course, the reasons for the disappointing figures can largely be traced to the implications of the COVID-19 pandemic, despite the peculiar factors in some companies, which gives us reasons to drill down on these earnings this morning, together with the head of portfolio management at Commercial Partners Asset Management, Victor Aluyi. Good morning, Victor. Thank you for joining us.
Morning. Thank you for having me.
So what's your general assessment of the company's earnings for the first quarter 2020 released so far?
I think, looking at the earnings that we've seen so far, particularly across sectors, even within sectors, what you're essentially seeing is a mixed bag. If you look at the banking sector, for instance, you would see certain key themes resonating across boards. You would essentially see sort of flattish to negative growth in interest income. We're also seeing a trend where the non-interest revenues are also ticking up quite significantly. We're also seeing a decline in interest expense. So all of that is also basically on the back of the lower yield environment. So clearly, a lot of the banks are unable to get the sort of yield that they were getting this time last year. We've also seen repricing on that on the deposit book as well. So that has also led to a decline in that interest expense number. We're also seeing net interest margins looking decent from where we were last year. So for instance, if you look at GTB, interest income pretty much flattish, rose about 3.4%. You saw declines of about 21% in interest expense. Again, this is basically on the back of the lower yield environment and the fact that the bank is also certainly repricing a lot of those deposits. We're seeing net interest margin at about 8.8%. OPEX is also growing. OPEX grew quite significantly, and the AMCON levy is a substantial part of that. So clearly, AMCON is supposed to be a 10-year entity. We're still not clear as to whether AMCON would go on after 2020, because it started in 2010. So if that were to happen, of course, that AMCON levy will continue to be a major part of their OPEX. Again, if there was a cessation of that or some sort of arrangement that would bring that to an end, then you would see significant improvement to bottom line as that AMCON levy will be taken away. If you look at balance sheet dynamics or balance sheet movement, for GT, loan book grew about 26% year on year. However, if you look at that between the end of 2019 and the first quarter of 2020, loan book grew by about 8% to about 1.6 trillion. If you also look at deposit growth, we saw about 14% growth year on year. However, if you look at it year to date, deposits grew by about 10.7% to 2.5 trillion. So we're seeing decent movements in balance sheet dynamics, but again, I think the lower yield environment is, causing that interest income line to be sort of challenged now as it is, but we're seeing, decent growth on that non-interest revenue line. With regards to impairments for GT, impairment number for Q1 2019 came in at about 1.2 billion. If you compare that to what we had at the end of at Q1 2020, 1.2 billion. If you compare that to what we had at the end of 2019, which was around 4.9 billion, if you look at the run rates, then you're probably seeing some sort of deterioration on that number or on that metric. If you look at another tier one pair like Zenith Bank, pretty much the same trend. You are seeing, interest income flattish, not really growing as strongly as we've seen, in previous years. We're seeing that growth.
All right, Victor. Talking about Zenith, where is the impact of FX devaluation that appeared to have also played a role in that bank? For example, the net dollar position of about $1.7 billion was able to help record some revaluation gains in March.
So a lot of the banks really are long the dollar. So a currency, devaluation, if you will, would prove positive for a lot of them. So yeah, that's how it's really going to impact them. Currency, because they are long the dollar, a currency devaluation would, bode well for them, really. So yeah.
Now, typically, GT Bank and Zenith Bank have the capacity to withstand these sectoral pressures relative to other banks. Where do you see the key lines such as NPL ratio, cost-to-income ratio, capital adequacy ratio by the first half?
Well, so for GT, for instance, they've been the market leader when it comes to cost-income ratio. Q1 number came in at about 40.6%, although that's slightly deteriorated if you compare to a year ago where it was about 38%. Clearly that rise in OPEX, is responsible for that. So in terms of, cost management and cost-to-income ratio for the banks, I think by the first half of the year, we're probably going to see, a slight deterioration, basically on the back of that, rise in OPEX. In terms of their balance sheet positioning, particularly for GT and Zenith, I think that they are well positioned, well poised to weather whatever storm that the whole COVID-19 challenge would throw at them.
Well, it's second quarter already. The lockdown has already engulfed about 36 days of business activities, coupled with possibility of loan loss provisioning in the sector. What does this tell you about the sectoral outlook for the rest of the year?
I think for the banking sector, there's been quite a number of challenges, at least over the last 1 year. The regulatory environment is, one of them. It's getting a bit harsher. It's one that is actually making the banks have to dig in and try to create revenue, grow revenue in more creative ways. So clearly, as the economy is challenged, you'll also see that challenge filter through for the banks. Loan book growth, we don't expect to see any significant movement there. So that would obviously challenge revenue growth and interest income growth for the bank. So going into, like you said, we've already had a significant amount of time knocked off, from productive days in Q2. So that will certainly impact revenue or interest income, particularly for the banks. And also that non-interest income line that has pretty much supported, top line growth for the last couple of quarters would also be challenged because of the pretty much shutdown in activity that we've seen for a substantial part of Q2. So yes, that would certainly take its toll and have a significant impact on those numbers.
All right, let's look at the consumer goods sector, especially the brewers. Nigerian breweries, for example, already confirmed that beer volumes remained flat over the first quarter. What do you attribute that to?
Well, I think, the flattish revenue growth for Nigerian breweries can be attributed to a number of factors. First of all, the parent company Heineken guided to the fact that, the price increase in February also affected, volume growth. The impact of continuing negative impact of excise duty would also continue to impact, them going forward. So we saw price increase in February, and also, some impact of the lockdown late in March. So that obviously affected revenue growth. But I mean, suffice it to say that the sector has been challenged for quite a while now. I've continued to see, the company struggle to grow revenue over the last couple of quarters. So I think that is probably going to even be more aggravated, particularly with the price increase that was implemented in February, with the lockdowns that we have seen. If you consider the fact that, Easter is typically a period where, revenue or sales, naturally be boosted. And the fact that that period was shut in, it would have a significant impact on the Q2 numbers. And then we're seeing continued lockdowns, just skeletal activities still. So that would certainly hit, revenue growth for the company quite significantly.
So we already saw the impact of the VAT hike in their earnings. Some have already increased prices as a result of that. But with the lockdown and social distancing measures that led to the closure of some of their businesses, how would that shape volumes and revenues in second quarter?
Clearly, like I said earlier, volumes are going to be challenged. There's really no way around that. Volumes will be challenged. The average consumer is challenged. General economic activities are challenged. So you've seen significant supply chain disruptions. You've also seen, significant demand shut in. So clearly, you're going to have, that impact come through quite strongly, particularly for that Q2 number. So yeah, for the consumer guys, Nigerian breweries, they would be significantly impacted by the the lockdowns that we have seen, and by the supply chain disruptions and also demand destruction that we have seen for the better part of Q2 2020.
For the food and beverages subsector, how is the COVID-19 economic disruptions taking its toll in that sector?
Very, very strong as well, because I mean, these guys are, I would say that they are pretty much in a direct line of sight for impact for COVID-19. If you look at a company like, Unilever, for instance, it's certainly going to affect them. The food segment contributes quite significantly to revenue. So of course, with the kind of demand shutting that you're seeing, supply chain disruptions, the impact is going to be quite significant, particularly when we see those numbers in Q2 and for the better part of the year, as a matter of fact, because the impact is going to be quite significant.
Now, is there any role that the lower disposable income and purchasing power of Nigerians could have in the second quarter?
Absolutely. I mean, even before COVID-19, the average consumer had been significantly challenged because of, we're essentially just finding our way out of a recession. So, the average consumer had been challenged, and then this challenge then comes in. Of course, the average consumer is, significantly bogged down and would basically be left to spend on stuff that is, essential. And even within that essential space, they will be forced to also trade down to brands that are cheaper and more affordable. So this is going to, pose a formidable headwind or challenge to the revenue drive for a company like Nigerian Breweries, and also for Unilever as well.
And overall, what's your outlook for the second quarter?
I think the second quarter would go some extent to reveal the sort of challenge that COVID-19 has thrown at us. The second quarter would also show us how challenged, the Nigerian consumer is. So clearly, those numbers are not going to be strong. If anything, we're expecting to see weak numbers for Q2 2020, but it will certainly be a reflection of the overall macro story of the overall COVID-19 challenge. And, just beyond even Q2 2020, I think we're likely to see that impact even linger for the better part of 2020.
All right. Thank you very much for your time, Victor.